Hi, this is Ashutosh Bhargav. I'm the fund manager and head equity research at Nippon India Mutual Fund. I've been tracking the equity markets for almost 17 years now. Today, I'm here to talk about Nippon India Asset Locator Fund of Fund. The name itself suggests that it's an asset location offering. As asset managers, we strongly believe in diversification as a strong tool to not only reduce risk, but also to improve overall portfolio returns. We think this concept of proper and adequate asset location is intuitive, and now over time is well understood by many people. However, due to various emotional biases, mainly greed and fear, investors often struggle to make optimal asset location by themselves. Here, systematic rule-based approaches towards asset location is one way to address this challenge. Now, coming to this particular fund, there are four distinct features of Nippon India Asset Locator Fund of Fund, which makes it different versus other hybrid offerings which are there in the market. First, it invests in three different asset classes: Indian equities, gold, and Indian debt. These asset classes are less correlated to each other. Their returns are less correlated. And we have seen that when one asset class performs many a times the other asset class make up for it with its performance. We have seen that winners keep changing between these three asset classes from one period to another. Second feature is it not only allocates between three different asset classes, but it also attempts to select better sub-asset class within an asset class. So, for example, within equity as an asset class, this fund shifts allocation between large cap, mid cap, and small caps. Or in fixed income side, it allocates between long-term and short-term debts separately. So the sub-asset class distinction and allocation is another distinct feature of this offering. Because time and again, we have seen that within asset class, also, winners keep changing from one period to another. For example, in the last 2 years, small caps within an equity asset class have outperformed the large caps. But in the prior 2 years, it was the other way. So the fund attempts to catch these trends within an asset class as well. Third, it invests in other funds, and that's why it's called fund of funds. So this fund of fund invests in our in-house funds which have great pedigree, so to say. Flagship funds which are managed by our senior most talent within the organization. So for example, if the fund allocates money to mid caps within equities, the allocation would naturally go into Nippon India Growth Fund. That's how for each sub-asset class, the relevant in-house fund is chosen. Most importantly, the fourth point is that rather than static or subjective allocation, the fund attempts to vary its allocation across asset classes and sub-asset classes, depending upon the signal coming from few time-tested indicators. The fund uses an in-house proprietary model, which combines select indicators to determine the asset location. Now, coming to the model specifically, typically asset location models are either macro-based, wherein depending upon macro forecasts like predicting growth or inflation, asset location is determined. This process involves forecasting lots of variables in a right way, and in practice, it is very difficult to execute. The other approach to asset location is based on valuation signals. Valuation-based approach is actually very useful when it comes to portfolios where equity is a dominant asset class. However, when one has to choose between three different asset classes where equities need not be the dominant asset class, then valuation-based approach becomes a less bit useful, so to say. So valuation-based asset class, asset allocation could be challenging to execute when one needs to allocate between various asset classes and sub-asset classes. So the model we use for this fund of fund neither involve forecasting of any kind, including macro forecasting, nor it takes into account conventional valuation parameters. This model framework is actually based on a multidisciplinary approach. In this very framework, we combine technical factors like momentum, global macro indicators like dollar and commodities like copper, etc., the trend of dollar, trend of commodities, and certain innovative behavioral factors that we have developed internally. All the variables constituting this very model are intuitive, have a very strong economic logic or explanatory power, and are available at a reasonably high frequency. So the models strive to achieve a fine blend of these variables, the complementary variables, which may help enhance risk-adjusted returns. So based on model signal, model allocates between these three asset classes and also signal what should be the ideal allocation to sub-asset class within these asset classes. So based on the signals that we get on a periodic basis, fund can take between 0 to 100% allocation in equities, 0 to 100% allocation in debt, and up to 25% allocation in gold ETF. To kind of summarize this fund of fund offering, it invests across in-house equity funds, debt funds, and gold ETF. The aim is to benefit from 3 layers of potential alpha: rule-based tactical allocation across asset classes, rule-based tactical allocation within each asset classes, and also the alpha potential from investing in actively schemes under consideration. Overall, Nippon India Asset Allocator FOF endeavors to deliver steady returns across market cycles. In a world where forecasting is becoming more and more difficult, something that we have observed in the last few quarters, this fund of fund offers a robust and unbiased dynamic asset allocation alternative. We believe it's an all-weather proposition and may be a part of any investor's core portfolio. In terms of return per unit of risk taken by any investor, this fund may do a good job over a medium to long term. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.